Welcome back to another episode of KIO Macro. Vince, Isaac, how you guys doing today? I'm joking. I'm the only one here. I hope you're ready to hear me rant about a few things, starting with the potential or actual bull market in crypto. Now that depends on who you are. We're going to touch on inflation, the labor market, as well as the potential for Fed rate cuts, or if they're going to cut rates at all in 2024. Let's get right into it. So I'm not going to share the chart right now, but I'm sure you guys have seen the retracement in Bitcoin back down to about 67,000. Now that's not unexpected, as we've been kind of calling a slight pullback for a few weeks here now to that run up to 73K. Because of course, if you have BTC hit an all-time high and you don't think there's going to be selling pressure, you might be a little crazy. And although we're seeing the amount of hodlers, or the time at which people hold their Bitcoin in a wallet, is increasing or staying steady, there's always going to be people who just want that money, okay? So they're going to take it. Now, obviously, I don't think this is a correction or the end of a bull run by any means, as that supply and demand imbalance that exists within the Bitcoin network at the moment, it will persist, especially as we head into the halving. Which, by the way, I hear people say like halvening, the halvening. I hear a lot. I don't know why it's so many different terms. The correct term is halving. Not that that really matters or anything, but I just thought that was funny. Anyway, the supply and demand imbalance I'm referring to, if you guys haven't caught wind of this already, because I feel like a few people have been discussing this specific topic, and that is right now, the amount of Bitcoin within the network that is created per day is about 900. The amount of Bitcoin that has been gobbled up on a daily basis by these ETFs, that could be anywhere between 3,500 to 4,300 Bitcoin every single day. So you can see that huge imbalance, and it's only going to become more exacerbated when the halving takes place, because now you're going from 900 new Bitcoin per day down to 450 Bitcoin per day. And so that supply demand imbalance, if this is supply and this is demand, demand is going to keep going here, and supply is actually doing this. So you can imagine that that only equates to upward price pressure, aka a tailwind for Bitcoin. So if you are hodling, don't panic, do not sell, because unless you bought at 20,000 or something, you just want to take your money out. Other than that, don't sell. We still have a lot of room to the upside in Bitcoin, and that's just purely based on the fundamental environment at the moment. Anyway, let me know what you guys think. Do you think that we're in a sustainable bull market? Do you think it's just all based on ETF demand? Do you think there's another factor that I'm missing? If so, leave it in the comments. And also, let me know what you guys think in terms of the potential Ethereum ETF. At this point, I do think there is 100% chance of approval with an Ethereum ETF. They already have spot ETFs in other countries. We already have a Bitcoin ETF, obviously. And so, yes, it's pretty certain that that will also be approved. And we know that the CFTC, this is separate from the SEC, they basically classify Bitcoin and Ethereum in the same category as a commodity. And so therefore, Ethereum will get the same treatment as Bitcoin did when it came to ETF approvals. So we shall see. Now, a huge topic or narrative that I know for a fact that you guys have been seeing pretty much everywhere is regarding Fed rate cuts. Now, they have an FOMC meeting starting tomorrow, which is March 19th. The last day is on the 20th, and that's the day the decision will be made. Right now, there's a 99% chance, as you can see, according to the CME Fed tool, there's a 99% chance they're going to keep rates steady tomorrow, which we all expected in the first place. So there's no surprise in that whatsoever. It's basically 100%. Just because it wouldn't make sense to cut this early, unless say inflation starts to rear its head again and you cut too early, that puts the Fed in a horrible position. You even got some people going as far as saying that the Federal Reserve is not going to cut rates in 2024 at all. I'm not quite convinced that that's going to be the case, but let's break this down. So to start, I want to touch on the labor market because something very interesting is happening. There's a bifurcation in jobs and unemployment, meaning the unemployment rate is going up while we're adding more jobs every month. Should be the opposite of that. So in January, the unemployment rate was 3.7. In February, it jumped up to 3.9. So a 20 basis point jump It's not super significant, but you'll see the relevance in a sec here. We've added 275,000 jobs in January. And so it's really hard to tell if the labor market is strong or softening, or both. It could be strong and softening, or this could just be a blip. We're going to continue to see as data comes out on the labor market. The consumer, they're still looking really good in terms of spending, right? And I know with government data, all this stuff, it could be weighted weird. The sample size could not reflect reality, but the data we do have, they're looking pretty strong. I mean, retail sales are up almost 1% year over year. And every single month, we're seeing positive prints on consumer spending. So there isn't really any retraction in terms of people spending money. They're still just spending like normal. So based on spending by the consumer, I would assume that the labor market is still healthy and we're just seeing a blip in that unemployment number. But like I said, we're gonna find out. There's no way to really tell at the moment, especially with all the revisions we've been getting pretty much on a monthly basis since the start of 2023. And this is one of the things the Fed is gonna keep watching as well in between this meeting and the next meeting. If the unemployment rate keeps rising, then we could trigger something called the SOM rule. Now, I'm getting ready to do a video on this on my personal page, actually, and write an article on our recently released newsletter. So if you haven't yet, guys, go subscribe to our newsletter, by the way. But anyway, the SOM rule basically states that you take the 3-month rolling average compared to the previous 12-month low. Now, if the unemployment rate jumped 50 basis points within that 12 months, and that's relative to the 12-month low, that would indicate a start of a recession or the first few innings of a recession. And so it's not a recession forecaster. It doesn't predict recessions. It indicates that, hey, we're starting the recession right now. And I'll just pull up my handy old Fred tool for you guys real quick. Now, if you look on here, I'm just gonna go through really quick. You can literally see that on every recession, pretty much, you got from anywhere from 0.5 to 0.53, and it's indicated that we're in a recession or the start of it with 100% accuracy. And so this is something I'm going to continue to monitor because now I have confidence that in real time, I'll be able to tell that we're in a recession or not, and I wouldn't have to rely on backdated information. Just so you guys know, the Federal Reserve, they also use this data, but right now, it's not bad. The latest number in February, for the SOM rule is 0.27. And so we're still basically halfway away from triggering or the SOM rule being triggered. So be on the lookout for that, guys. Moving on to inflation. Now, when it comes to inflation, you know, I like to reference Trueflation, but I'll start with the last CPI and PCE print really quick. So core CPI came in at 3.8. while core PCE came in at 2.8. So the Federal Reserve's preferred inflation gauge has been showing some progress, albeit it's pretty sticky though. And a large component of that stickiness is because of shelter inflation. And the way shelter is calculated within the CPI and within just government inflation gauges period, I mean, it's done pretty horribly. We probably have a long lag to go before they even catch up to the real data in real time. Services as well is a huge portion of that. And if the consumer is going to keep spending in the way that we are, I don't see service inflation coming down. And I don't see how shelter inflation coming down either. And so for me, inflation, the lowest it could actually go, at least according to government data, is probably 2.5% at this point. Unless we start to see real disinflation in shelter and services. But once again, we shall see. So let's look at Trueflation. Okay, guys, as you can see, that Trueflation number, this is as of the recording of this video, of course, is sitting at 2.13%. Now, there are slight differences in the way that Trueflation weights certain pieces of data outside the government, but at the same time, they use 10 million data points versus 30,000 data points. I gotta go with the 10 million data points. And it's real time, built on the blockchain. If you guys haven't noticed, I trust Trueflation more than the CPI in terms of where we are. But I do recognize that the Federal Reserve, they're using the CPI and PCE. So we must know what those numbers are telling us at any given moment whenever those press releases come out. So if you're one of those folks who say, oh, I don't want to pay attention to that data because it's not real, keep in mind, your money printer is using that data. Remember that. But anyway, so if we're going off trueflation, the Federal Reserve has basically hit their goal already, right? So you can see it basically, of course, you got some peaks and troughs, but for the most part, the trend is downward. And so they're pretty close to their goal, if not already there. If I'm going only off of trueflation, they're at that goal. And this is part of why some individuals are projecting that the Fed will not cut rates, because they've accomplished their goal on inflation. The consumer is still strong. The labor market's strong. I think they're downplaying the commercial real estate risk, but they also cite that that may not be a huge issue as well. And so really, there is no reason for the Federal Reserve to cut rates in their eyes. Now, one thing I've noticed about inflation numbers over the past probably 2 years is that they're sticky to the upside and they're very volatile. Let's say if they cut on the 19th or the 20th, they won't do it, by the way, but let's say if they did, they would only risk reigniting inflation, pushing the economy into an overheated state once again, which we don't want because they're going to be in that same fight all over again. So why would the Federal Reserve cut rates this year anyway? By the way, sorry about the sun. It's getting pretty bright over here. I didn't expect the sun to just start beaming on me. So if I'm shining a little bit too much for you, my apologies. Anyway, so I've recently wrote an article on this. The 3 reasons why the Federal Reserve would actually cut rates, it would be because the commercial real estate maturity wall, the real Fed funds rate, or they've actually achieved a soft landing. Now, let me go through each of these quickly. So the commercial real estate maturity wall essentially refers to a short period of time in which a large chunk of these CRE loans come due at the same time. Now, one thing that we're fully aware of is regional banks, their exposure to commercial real estate is pretty hefty. About 70% of commercial real estate loans, they're handled by regional banks. And so these are the banks that don't have the same capital requirements as your commercial banks, and they're willing to take on more risk for a higher yield relative to the commercial banks. They would be more conservative in their approach. So commercial real estate lending, for the most part, drastically, is handled by these mid-sized regional banks. So just in 2024 alone, we have about $1.5 trillion worth of loans to come due in the CRE space. The question is, with interest rates where they are, or where they will be potentially when those refinancing walls come about, will CRE owners have to refi at a higher rate? Will they be able to sustain it? Will they default? A lot of this we won't find out until it happens. So I'm going to keep a close eye on that as well. But anyway, what would alleviate that pressure is the Federal Reserve lowering rates. And so if they sense that, and Jay Powell said he didn't sense huge danger, but you got to take what he says with a grain of salt here. If they did sense a huge danger in the commercial real estate space, that could prompt them to either lower rates or develop some type of alphabet soup program to basically shore up those regional banks. But I doubt it. They'd probably let those guys fail. And interest rate policy would be the best method to help save these guys. Because if they have to refinance at 5%, and most of the loans are at 1 to 2%, they're literally just going to lose billions of dollars. So that's going to be really bad. The second reason they would cut rates is to bring the real Fed funds rate down from a restrictive level. A restrictive level can be looked at, well, it can be looked at anything above 0, but like actually restrictive, you could say anything above, like, let's say 1.5% or so. The real Fed funds rate is calculated just by taking the nominal Fed funds rate, which is right now 5.25, let's say that for easy numbers, and then you minus whatever the current inflation rate is. People use different gauges for that. Some may use the CPI, some may use PCE, some may use trueflation at this point. But if we use PCE, the real Fed funds rate is basically sitting at about 2.5%, which means they're overly restrictive. And staying here alone could push the economy into a recession. So consumer spending doesn't start going in the opposite direction and the consumer starts to get hurt, the Federal Reserve will start bringing back some balance in terms of restriction versus accommodation in the market. So that would be another reason that they actually cut rates this year. The third reason, believe it or not, if you've been watching this, you know how I feel about this one, but they've actually achieved a soft landing. Now, the way I like to describe a soft landing is, imagine, right, you're on a plane and you jump out and you start moving your legs, you start running. And when you hit the ground, you lose no speed, you still run. Then you can kind of stop if you want to and relax. That's basically what a soft landing is. So the mission of the Federal Reserve was to bring down the rate of inflation, so to have disinflation enough where it gets back to about 2% without causing a huge spike in unemployment, which would indicate a recession. So to avoid a major slowdown in that event, I guess this kind of goes with the second point in terms of bringing that real Fed funds rate down. They will feel comfortable, and they've mentioned this a bunch of times, having a period of below trend growth versus a period of negative growth. And so those are the reasons they would actually cut rates. Now, if they did cut rates, initially it may not be, but it would also be very, very bullish in terms of global liquidity for Bitcoin as well. And so that goes all the way back to the beginning of the episode when I said, I don't think the BTC bull market is actually over. We expected that retracement. But anyway, guys, let me know what you think down in the comments. Do you think the Federal Reserve will cut rates? If so, how many? Do you think that we're done with the Bitcoin bull market? Do you think that we're just getting started? Do you hate or love ETFs? Either way, leave a comment below. If you enjoy this content, tell your mom, tell your daddy, tell your uncle, tell your auntie, tell everybody. Make sure you subscribe, like, and leave a comment. Also, feel free to book a free strategy session, link in bio. Appreciate you guys, and see you on the next one.